Hi, Woody here for the New Look Insider. Now, I reckon I've got another couple of weeks of claiming the new look while it's still fresh, but I'm going to milk it while I can. Today's conversation is with Vern Gowdie, the co-editor of the great Rum Rebellion e-letter and editor and founder of the Gowdy letter, and also a brand new, soon to be launched to the wider readership, a new virtual planning advisory, which we'll touch on in a moment. But first, welcome, Vern. How are you handling ISO in Queensland, right by the beach?
Yeah, it's tough, mate.
Yeah.
One day is the same to me. Isolation has been part of my lifestyle for some time now. So no real change.
Same as usual. Well,
same.
Part of this, the first issue that Greg and I did of the New Look Insider a couple of weeks ago was that I asked readers for some comments and questions on what's concerning them, what's keeping them up at night, and what kind of ideas and topics they want us to address. So we had a number of responses. I've been steadily going through them, and there are three in particular today that I thought I would raise. I figured you'd be the ideal person to comment on them. But first, I guess it would be good to just back up a little bit, because I know we've had a few more readers on the Insider, and a lot of people know who you are. Perhaps some people don't. So I thought it's probably best to start from the beginning, really. Now, you're our most well-known, probably our most bearish editor. How about you start by telling us about how your own personal experience has brought you to this viewpoint today?
Well, I tried to address that labelling of bearish in some recent newsletters. Is that I actually don't see myself as bearish or bullish. Just I take an opinion based on the data that I get. So that I have. So if I think things are getting a little bit too optimistic, then I lean towards I think we should be pessimistic. But if things are too pessimistic, I'll be optimistic. But how did I get there? I'm 60 years of age, soon to be 61, and I've been involved in this industry since I was 27. I started in 1986. So having gone through the 80s, the baptism of fire in 1987, and then some tough periods during the late 80s, early 90s in the industry, and then the tech boom and bust and subprime and the eventual bust of that. You'd be silly if you don't learn things along the way. If you naively believe that, there's no pattern here, or there's no that there's what are the underlying reasons for all this, and that's what I've done over the last, probably more so the last 20 years since the tech boom busted, is saying, hey, let's look at this a little bit more deeply, because the industry is it's a funds management industry. It's about managing funds on which they get a percentage, so they are always going to have a more positive view, and in the long term things will go up and that sort of thing. But you've got to find out what the underlying drivers of that is. Is it population growth? Is it in what we've seen? Is it debt growth? Is it what's actually beneath all this, and find out if that's sustainable. So if I've been bearish, it's because on a number of things, and we're starting to see that being unraveling now, is that there's been an enormous amount of debt that's gone into try and reflate markets or asset prices, and it's just not sustainable. Hence the sheer scale of what reserve bank or central banks have done in just trying to patch up this current bubble. What the amount of money they've had to throw at this, and this is only early days. So
well, you were pretty astonished by the debt prior to the COVID-19 stimulus. I say stimulus because it hasn't really stimulated anything. Well, it has nominally in the markets, but do you want to comment on that?
Yeah, I actually, in today's Rum Rebellion, in the Rum Rebellion that's published on Thursday, the 30th April, I actually had a great graph in there, or chart, from the Deutsche Bank, and it shows going back from 1970 to now, this 50-year growth in debt. And they also then superimposed on that these little bar charts of stimuluses, for various crises that have happened since the 1970s in the G7 countries. And this last bar chart is like, the Empire State Building compared to a house. All the others are like little houses. This thing is just off the chart, because they've just got such a huge amount of debt out there, and and a lot of it's gone unproductively or into unproductive use. So as this bubble deflates, they're trying frantically to try and who can we save? Who can we roll out a $750 billion package to? Or and you just see New York State the other day just said, well, we're broke. Who's going to backstop our pensions? So everyone's got their hand out because the whole system is just weighed down with debt. And Ray Dalio has just written a great book just recently about the changing world order. And he also talks about the end of the debt super cycle, a cycle that began over 70 years ago in the post-war period. And these things happen, but they're decades in the making. And so there's just way too much debt in the system, and it has to get out there. That's why it's not, the market action is not reflecting economic reality.
Well, I was going to ask that because you mentioned your experience in the previous 4 big downturns. You had your time when you were still in the planning industry, and you kind of worked through 1987 to 2000. That's while you were still practicing. Mm-hmm. Obviously, the 2008 bust happened, by which time I think you'd already sold your business at that point. Well, now the recent crash.
See what was happening. So we made positive moves to actually sell our practice because I believed what was going to come would have a detrimental effect on the valuation of practices, and that's as it's transpired is what's happened. If you look at all the recent news about.
Well, just out of interest, what did your peers say at that time?
Well, they were happy to pay the price, so obviously they were more bullish than I was.
Yeah, right. But I was going to ask. I find it.
I was told I was nuts. Why are you letting go of this? Yeah.
I just find it to ask you through your experience. I just wanted to clarify something because I know it's something that might confuse a lot of readers. Is that the markets have actually rebounded quite strongly since just the crash in March, and I think just before we were recording, I mentioned that the Nasdaq is for example is just 1% off its all-time high where it was at the start of the year. It kind of suggests this downturn is short-lived, but you're suggesting it's part of this big, long bust. So I was going to ask how you reconcile the two things.
Yeah, there's, it's a chart I've published previously in Rum Rebellion and the Gowdy letter. It's about the 4 phases of a market, and it's really a psychological profile because at the end of the day, markets are you and me. They're based of human. So you look at the tulip mania, you look at South Sea bubbles, you look at all these, the roaring 20s. There's always a pattern to it because our character flaws come out. So, we're cautious and then we end up being supreme optimists. And then when things, the wheels start to come off, we go, no, this is just temporary. And we sort of think, no, things will get back to normal. And then the thing's out of balance, so it needs to fall. We're in that sort of denial, return to normal type phase of this psychological profiling, and they never ever recover, these markets. I think we came down, like the Dow came down from 30 to 18, and it's back at 24, or close to, and it won't get back. I can't see it'll get back to 30 because markets are based on earnings by a multiple. So maybe call me silly, but I don't know if earnings are going to be that good in the near term. I could be wrong that, shuttering the economy has no effect on the bottom line of companies, but I don't think I am. So earnings are going to be down. So if you've got to get back to that price, then you've got to have a multiple that's way higher than what we previously had, which was already historically high. So mathematically, it makes no sense. Logically, it makes no sense. But then again, markets are emotional beasts in the short term. I think what they say, they're a voting machine in the short term and a weighing machine in the long term.
Yeah, right.
So people are just, and don't forget, there's a lot of day trading, short covering in the market. So there's a lot of day-to-day action that can make things. But underneath all this is a deteriorating economic picture.
So what are you meant to do? I mean, because it's just kind of human nature to want to do something, right? You want to do something with your money, but you're kind of sitting out, aren't you?
We are. Well, no, I'm not sitting out. I'm just in a different asset class.
Yeah.
You know,
That brings me to my next question: is what you're doing with your money right now?
That's a mentality that, again, people think, oh, of course you're in markets, of course you're in the bank. You're not really investing. Well, yes, I am. I just want to invest in something that doesn't carry significant risk, because I think there's still a lot of risk in markets. And I look at Warren Buffett. And I think he's been building up a war chest there. I think it's about $130 billion in Berkshire Hathaway. And he came out last year and he said, I don't want to have the cash, but I can't see if I move it out of the bank, that $100 out of the bank, and I buy something for $100, then there's probably more risk that's going to be worth less. So I'm better off just keep my $100 in the bank. As much as I don't like earning 1% on it, I can't see anything else out there. So, and I think that's a mindset that people have, that I think the industry has done an excellent job in sort of embedding in people. Said, oh, if you're in the bank, you're doing nothing. Well, no, you're just waiting for the appropriate time where the equation for risk v reward is in your favor. And what I saw was that there was a very high risk in markets, and there was no reward. You weren't going to get rewarded for that risk. When markets have fallen 50, 60, 70%, the risk is out of the market and the rewards are much higher. We all know you buy low, sell high. But very few people actually practice it or have the patience to wait for those points where that equation is in your favor.
Or perhaps understand that can happen within cash as well. So, I mean, just to give perhaps you can just elaborate. When you say cash, you mean some Aussie dollars, some term deposits?
Oh, yeah. Sorry. Yeah. You're correct. I moved a substantial amount of money into US dollars in 2012. I forget the year. But we moved it around about, we were getting $1.05 US for our dollar. And to me, that seemed like a really good risk trade-off. What was the chances of me losing a lot of money? If I was to lose 50% on that trade, on that, our dollar we would have had to go to $2.10. We would have got $2, and that was never going to happen. The historical norm's around 75 cents. So I thought that was very little downside for a lot of upside, and that's proved to be the same. And we bought UK pounds at 63p, and I remember saying at the time, people saying at the time, oh, you're stupid, the Brexit, it's gonna, the pound's gonna go down the toilet and da-da-da-da-da. And I thought, well, that was the prevailing mood at the time. The overwhelming sentiment was on that side of the boat was listing there. I thought, maybe not. And as it turned out, it was pretty much the high for the dollar against the pound, because our traditional, as you would know, the traditional thing is about 50. $1 buys about 50p.
Yep.
So we were tilted. We were at 63. And there's been times where we've been down as low as 30, you may remember, into the 30s. You just got to look for these imbalances and where society is at there in the main. So that's why I love talking to people, just finding out what they're thinking. And if there's a commonality of thought, I think, okay, I'm looking the other way.
So that's your strategy, what you're doing at the moment. But you've also got like 3 daughters, and I'm sure the vast majority of our readers have sons, daughters, grandchildren. Perhaps some have great grandchildren. What's your advice to that generation? Well, I'm assuming it wouldn't be the same, right? Or would it?
Absolutely, identical.
Right?
Why do you want to lose money at any stage of your life? So if there's times in your life you need to be patient, then be patient. But from a very young age, we've openly talked about money, business. How we see the world, the economics, politics. We've had an open discussion. Now they're all at different parts of the world now, London, Paris, Sydney. But thankfully, due to the marvels of technology, we speak regularly, even more regularly in recent times. So, and my advice was always that A, don't get into unnecessary debt if you don't need to. And B, when they're looking around, one was looking around at a house, maybe. I said, just hold off. I think better opportunities will present themselves. So we've been very mindful about that they have to live, they should be budgeting and putting away about 10%, and they do. So, that gives them a buffer, a cash buffer, which they've been very thankful of in in recent times. And also, I think it's been from a timing perspective, this couldn't have happened at a better time for our family, because they're now 26, going on 27, coming up 29 and 30.
Mm-hmm.
They've had some life experience. 10 years ago, this would have meant not a lot to them, but they're now out there and appreciating the things that we've been talking to them about. And again, I've just been saying, listen, let's just be patient. Let's just wait. There will be some opportunities to come out of this. And, and the value of what we've been talking about is starting to actually, they can physically see it, because they also know what some of their friends are going through and some of the difficulties they've got themselves into.
It's a good point, actually. The founder of Port Phillip, actually, and a good friend of both of ours, Dan Denning, I remember him saying before he went on his travels back in 2014, there is a whole generation of workers in their mid-20s that have never, ever experienced not even a single quarter of a recession, let alone a downturn.
Yeah. Well, and you could really go back and you could even extend that out to the people in their 40s. The last recession, the official recession we had here was in the early 90s. So, even if you were 20 at that stage, and I remember being in my very early 20s in the UK in the early 80s, and there was a severe recession. I had no idea, as long as I had enough money and a few quid in my pocket to go and buy a pint, I was happy. So really, unless you're about 25 in the early 90s or over, you really never had.
That's true. Actually, I mean, I was in my early 20s in the tech bust, and I had no recollection of that. Yeah.
So if we go back 30 years, really, I'd say anyone under the mid 50s doesn't know what that paying 17 and 18% interest rates and the pain that caused, and the lineups at the bank. I remember lineups at Metway Bank, which was now Suncorp, but people fear went round. A rumor went round that it was going, and there was lineups. So unless you've actually gone through that, and so there was such a long time between then and now that I think a deal of complacency got in there. And I get back to what I said earlier, Woody, is that people never really, and it baffles me to this day, they never understood what that secret of our so-called economic success was. And all you got to do is get a debt chart, and you see that we went from $800 billion of national debt, I mean personal, corporate and public, in 1990 to nearly $8 trillion today. And even if you put in there a factoring for inflation and population growth, it's just been a debt-a-thon. And so there's been no magic. And as interest rates came down, people could take on more debt. So there's been no magic formula to all this. The central banks have, haven't they managed this well? They have been reprehensibly irresponsible. And now this is why they're having to roll out such massive stimulus packages, because they've, so many people have bought into this belief of, we can live beyond our means. And the problem is they've dragged forward all that money, all that debt has been dragged forward, all this consumption from the future. And now the future's coming, and I think you're going to find a very big mismatch between supply and demand. The world is geared up to supply a lot of things, but I don't know if the demand's going to be there to buy it. And that's why I think we're going into this deflationary cycle, which is the next phase of all this. We've had the big blow up with COVID and the shutdown and all that sort of thing, but it's the underlying psychological changes that will happen from here.
Well, that's something we were talking about earlier in the week in an editorial meeting, wasn't it? Well, actually, no, it was with our great guy George, our compliance guy.
Yes,
we had a meeting and we were talking. You were making these warnings way before the COVID crash, but the COVID thing was just you were saying it's just a pin, really. It was coming. Well, something's going to cause it.
Yeah. It's always something. Is it an archbishop who gets shot? Or is it whatever that trigger is? But the debt pile, the tinder is there. It's piling up. It's a bit like the bushfires. They've had. We're having another royal commission, but they've had umpteen royal commissions before, and it all comes to the same thing. There was too much fuel. So was it a match, a cigarette butt, a lightning strike, or a flamethrower? Whatever ignited that, the fact is the fuel was there. You don't get bushfires in a desert. because there's no fuel.
Yeah.
So the fuel's there as to what the spark's going to be, and where is it going to be thrown in New South Wales or Victoria, or by a kid or by an adult or accident or by God? Who knows? But it's coming.
Well, so that kind of moves us nicely on to what I want to the reader questions that I thought I'd put to you. The background is a couple of weeks ago, me and Greg requested lots of readers to come to write in what you're worried about, what you're concerned about, what opportunity, whatever you want us to discuss. And we've had an influx of emails, and I just picked out 3 that I thought would suit this conversation pretty well. So here's a question from Simon. Quick question. What are your thoughts within the office of where the US and the Aussie dollar are heading? So that kind of follows on from what we were talking about a little bit.
Well,
a while ago.
Given that these are impromptu questions, I'm glad you started with an easy one. Those Aussie dollars I bought in 2012, I am still holding them. My long-term belief back then, and I am a very patient investor, is our dollar will go under 50 cents. It was always my belief, and the reason for that, is that in a downturn, and we've seen that in 2000 after the World Trade Towers were attacked, when there was concern, I think we dipped into 48 cents then. And in 2008, I think we're down to low 60s, maybe high 50s, low 60s. When the world gets a bit frightened, they run back to mummy. The money goes back to the US treasuries. They want to go back to the safety and nurturing of, if all else fails, the US government will honour my dollar. I don't care if I don't earn anything on it, but I know it's going to be safe. So to do that, you have to buy US dollars. If you want to buy US treasuries, you've got to buy US dollars. So, this flood of money comes in, supply demand, dollar becomes, and we saw that briefly a couple of weeks ago. We dipped to 56 cents? We're now back to 65. It's come back. But when this next leg in the market comes down that I'm anticipating, I am still expecting we'll be sub 50, and that's when I'll exit that trade, that investment with a 100 and something % return. Oh, more than that, yeah.
So look out for the 50 cents level, basically.
That's what I'm patiently waiting for. So I don't trade. I don't do that sort of stuff. So if someone's looking to say, I'll get in 65, and my view is that we will get. But like all things, when it's down at 48, you'll start. And I'm glad I'm going on record here now. If we get sub 50, you'll have all the economists out there talking about, we're going to go lower. We're going to go lower. Because they all hop on the trend. But at that stage, that's when I'll be selling. When I hear some mainstream economists talking about getting lower, I say, it's time for me to sell.
Yeah, right. Well, Simon, I hope that answers your question. We got another question from Carmel, and it's quite a long one, so I'll try and pick out the question from it, and I might even touch on the background of where she's coming from. But I guess it relates to having the vast bulk of your wealth in cash in the bank. So she says, hi, guys. Many of us who are holding cash in our bank accounts are concerned as to whether the $250,000 guarantee that bank-held deposits are safe will hold water at all in the event of a depression or a fiscal meltdown. Is cash really safe in our banks? And if so, for how long?
The government has, as everyone knows, we've got the deposit guarantee of $250,000 per tax-paying entity per approved deposit-taking institution. It's the question I'm always asked is, but is that really going to be the case? And my unequivocal answer to that is yes. On what do I base that? There's legislation. Albeit that legislation limits the payout of the government to $20 billion per institution. So therefore, things like Commonwealth Bank and the bigger banks who have much bigger deposit balances are technically not covered by the legislation. But I think this recent action by governments has shown us that they will move hell or high water to bring confidence back into the system. So, who would have thought there'd be $130 billion stimulus package when we woke up on New Year's Eve, New Year's Day, So the long answer to this is the government will honour it, I believe, will honour its $250,000 guarantee. It may mean that it says we got capital controls. You can physically see that, you can see the 250 in your bank account, but you can't actually get it. But it's still there. You haven't lost it. And also, and I've said previously is, people say, oh, the government hasn't got the money to back all this. Well, we're just seeing that they can print it. We're now seeing they can print it. And you're now seeing that they're wanting to restore confidence in the system. That's why they've introduced JobKeeper and JobSeeker and all these things, these stimulatory measures, so that there's the social cohesion is still within the. Do you really think they're going to let the banking system fail? Seriously? That they're going, nah, that's it, boys. We're limited to 20 billion. No, all those people who got money in the Commonwealth Bank, too bad, gone. No, it's just not going to happen. It's just not going to happen, because don't forget. And I wrote an article about this. Companies like Woolworths, this is a while ago, have $1.2 billion in cash somewhere. And I assume it's with, maybe, let's say it's with the top 4 banks. So do you really think they're going to stand by and let the government confiscate everything above $250,000? Who are they going to pay their suppliers, their leases, their staff? It's just not going to happen. So we've seen governments do that now. The actions they will undertake.
Well, there you go, Carmel. She's also, by the way, she's also needing to buy real estate, and she's just wondering if whether the priority should be to get her cash into a hard asset. I mean, obviously, we're not talking. This is just hypothetical, big picture. Whether it's better to have the cash in the bank or to put it in real estate, something which is more tangible, in a hard asset or something. I don't know what you think about property at the moment.
Yeah, I think it's all interlinked. What we've had is it's called it's been dubbed the everything bubble. So everything but cash has just floated higher. You look at these prices being paid more so in Sydney and Melbourne for properties that are now, as a multiple of household income, are at ridiculous levels, high levels. But that's been because there's been the debt availability, there's been population growth or immigration, and low interest rates. So again, I think they've been priced for perfection. And maybe call me silly, but I don't think everyone who's lost a job is going to get a job back after this is all over. So therefore, there's going to be some forced selling. The banks will carry this for a while, but they won't carry it indefinitely. They're going to have to make some commercial decisions. So, I think there's going to be a flow-on effect to the property market. And I also believe that, we're heading into a deflationary spiral. The US bond market is pricing it for that with their inflation-linked bonds. Out to 3 years, they're pricing in zero inflation. So I think as we go through this deflationary period, those assets, cash will become worth more. $1 in the bank will buy more and more as these asset values fall. So, for example, at the start of the year, you needed $90 in the bank to buy one CBA share. Well, now that if you had that $90 still in the bank, you can buy 1.5 or more CBA shares. And so, if the CBA shares get to $45 or $20, you'll be that money in the bank will be buying much, much more. So it's actually appreciating in value in a deflationary, depressionary environment. And I think the same will hold true with house prices. What was once worth, say, $1 million may end up being around the $700,000. So your $1 million in the bank is going to buy you 1.5 times more home. So I think there will be a time, absolutely, to get into hard assets. I think as these negative numbers continue to come through, you'll see these, I call them numbskulls in the central banks, because I really do not have any, my respect for them is because I think they've taken us to a point we should never have got to. But anyway, they will just keep rolling out more and more stimulus, which at some point will bite, it'll grab. And that's when that's when inflation could take hold, and you don't want to be in cash. But I think we're still working our way to that point.
That's interesting. So I guess Jeff's question is the third one, final one. It kind of touches on all the things we've been talking about, really, but it's probably voicing quite a few of the challenges and confusion that many people are feeling right now. So he says, "Good afternoon. I'm getting mighty confused about what an investor ought to do to be well placed to exploit future opportunities. Australian government treasuries, cash or gold, or maybe US dollars. Is that a sound mix? I guess it depends on the outcome. A deflationary bust, ? It's all very confusing." How do you simplify it for everyone, Vern?
Right. Oh boy. That's why I'm saying.
Is that more of a loaded question than it
No.
sounds?
No. I understand the confusion because there's so many different opinions out there on what scenarios we're going to have.
And that's just portfolio publishing.
Yeah, I know, within our stable. But, you know, the stuff I read, you know, you got your institutional economists who are saying one thing and, you know, you hear all these different views and it is confusing and if you're not familiar with, you know, the data or the history or you go, wow, that sounds like a plausible argument or maybe that. And so there's this confusion reigns. The simple answer is that's why I've stayed in cash. Is you know, you've got 4 options really for your money: cash, you know, property, shares, precious metals, and there's the bond market. And again, I don't know if a lot of people understand how the bond market works with the inverse relationship between interest rates and the duration risk and all that. It's, you know, people see fixed interest and go, oh, that's safe. Well, you know, you try and simplify things. It's not easy. So I'm in cash. That's my simple approach.
That's about as simple as you'll get, isn't it, really?
Yeah, because I just want to see how it all falls down and where the opportunities present themselves. But the model portfolio I've got for our family wealth and for the Gowdy letter and the new service, the Gowdy advisory, is very simple. It's basically Australian shares indexed, international shares on an index, real estate on an index fund, and gold and cash. It's again, it's not overly complicated because I think the majority of gains you make, Woody, over the long term are being in the right asset class for most of the right time. You know, that's why the share trading or buying in and out of shares doesn't really interest me because I don't want to work that hard. And most fund managers, it's shown over a period of time, can't beat the index anyway. So I don't want to overly complicate my life. So at this stage, I'd tell Jeff to, my view is that I'm just staying in cash. Again, I'm running contrary to the stable of editors within Portfolio Publishing and Agora at whole and Bill Bonner. And I'm a believer that gold's going to get sold off because I think you're going to see a scramble for US dollars from emerging market. There's trillions of dollars in emerging market debt that is getting hurt and hurt bad. And if the US dollar continues to strengthen, they're going to have to come up with more local currency to buy one US dollar. So how do you get a like-for-like swap? Sell gold. It's US
gotcha.
Well,
maybe a future insider will be a debate between you and Shay. I think that'd be a good one.
Yeah, I agree with her that in the long term, gold will appreciate with the inflation thing. I just think that, and again, I'll go on record here. My belief is that in US dollar terms, the gold price will be moving closer to $1,000 or below in the next year or two. But having said that, I did buy gold under $1,100 for clients. You know, I wrote about it, but I waited for the heat to come out of it from 2011 to 2015 before we did that. So you know, we've done very well out of that, but I'm actually now looking to exit that trade. So that might just add to people's confusion because they get the gold up on one side, and then you got Gowdy saying no, he's getting out of it. So. Well,
I think that was a simple explanation for Jeff anyway.
I don't know.
How about you? You mentioned your other service that we're working on. Perhaps we can just finish on talking about that, what it is and how we came about it. I guess it leads nicely onto that, really. It's only available right now for the Gowdy letter readers, but we're going to look to open it up.
Yeah, depending on what the membership numbers look like. Do that.
Perhaps explain the idea behind it, and then how it's kind of, because we've always said the Gowdy letter is roughly 80% market commentary, the debt bulge, and 20% actionable, obviously with cash allocations. But this is going to be a lot more solution based, isn't it?
Yeah, it's financial planning has been in my blood for a long time, and a plan is not just, okay, here, Woody, get into this and make it. That's what people want. They want some sort of asset allocation model or that type of thing. But that's just one facet of it. Yes, let's say that makes you a whole lot of money, but you haven't got your estate plan right. So the money goes into the wrong hands or whatever, or you could have done something different in the self-managed super fund with the beneficiary nominations or so. There's a whole host of things, or your insurances. I don't know how. Obviously it depends on your individual circumstances, but there's a lot more goes into a good wealth management plan than just buy this and sell that. And so I was fielding inquiries from family, friends, and also readers over the last few years.
But I think they picked up recently, didn't they?
Yeah. But I gave freely of my time and chatted with people and that sort of thing. And there was a demand there, I felt, for people looking for more. They wanted to tap my knowledge for guidance. But there wasn't really a business case there for that, because while things are going well, people think the status quo tends to remain the same in the main. But obviously in the last month or two, that inquiry rate, there's been two things. One, it's increased, but two, the questions are now different. What if, what should I be doing? How's this work? And there's a whole lot of other questions that started to be raised that was sort of beyond the remit of of the Gowdy letter, And again, there was time and a whole host of things involved that just made it impossible. It's not possible to answer that. And again, quite frankly, that's not what the role of the Gowdy letter was. It wasn't to provide you with extended financial advice on other areas that you were concerned about. So, as I said, and I mentioned it to you, that this is something I've been toying with for some time. It was like a virtual type planning service that I think would add value to people because, as we've seen with the Royal Commission, and as I know from my time in the industry, there are conflicts of interest. You have institutional ownership of or association with financial planning firms, and the money tends to gravitate to the institutional owner. When I first started, it was just a cottage industry. There was none of this institutional ownership, but the institutions found that there's a lot of money to be made by having this pipeline from planners to product. So getting independent, unbiased, there's no agenda attached to it type advice. It's out there, but it's, you've got to look for it. There's few and far between the genuinely fee-based advisors who will, you want to go and see them, they'll just give you a bill for $300, $400, $500 for the hour that you saw them. And you go away and do whatever you do. You go and implement the product yourself and they get no commissions or clip of the ticket or anything like that. That sort of advice is very thin on the ground. So I always felt there was a need for it, but it's like you got to have the right time for these things. And it appears now is the right time because the level of inquiries have picked up. People are they want a deeper insight into what's happening. So I kind of liken it to sort of the members being sort of in this inner sanctum, that we're actually, I'll be sharing what I'm doing with our wealth, but also where they can give me inquiries and the research team we're going to put together, the team, we'll start looking into that. And then on a fortnightly basis, we'll have a video hookup, much like we're doing now, but they won't be able to ask questions, but those questions that they've sent in, we'll be able to go and dedicate some resources to finding out some solutions for that in a general advice type environment. Should I sell it? You can't give personal advice because there's the know your client rule. And obviously I don't know their personal circumstances, risk profiles and that, but most things in this business are about guiding principles, the do's and the don'ts. And you can then apply that or be given direction as how to where on what you should be considering tailored to your circumstances. And it's, yeah, I don't know of another service like this. It's something where, you know, and to your credit, it's something that you've been prepared to back, because it's really a brand new. I didn't even know if it exists in the States or the UK. You know, it's just something that I think there's a need for, and you know, and
yeah. Well, I think it's it's a unique project, and I really can't wait to introduce it to the wider subscriber base.
Yeah, and again, it's a balance between the amount of members that we within the advisory service, because we want to be able to, you know, we don't want. Yeah, it's a balance, you know, and you know, that's why it's priced at the level it is. It's as close to a professional service as you can get, you know, and you know, you've got to respect that.
Well, that's great. I think we can end there, Vern. I can't. Yeah, I mean, right now the advisory is only open to the Gowdy letter readers, but we're hoping to open it up to everyone in early May, depending on numbers. But it's something we're really excited about. So yeah, thanks for taking the time to talk, Vern. And I'm sure this will be one of many conversations in the coming months and weeks.
I think so. I think, you know, the cycle has turned, and we're now going through a period where people are going to have to adjust their thinking. And the sooner, I believe, they adjust that thinking, the better they will be in being able to handle the period we're entering into.
There we go. Cheers, mate. You can get your board shorts back on now and jump into the surf for your afternoon swim.
Sounds good, Woody. Thanks, mate.
Take care.
Cheers. Bye.